Palantir's stock price has been falling since they reported earnings last week, and in this video I want to do a stock analysis by looking at the fundamentals of the business and using my Excel spreadsheet to determine what price you should pay for Palantir stock. Let's start by explaining how Palantir makes money. They sell software to companies and governments that need to figure out their problems using their data. Palantir is split up into three main products: Gotham, Foundry, and Apollo. Palantir has very good fundamentals as their business model is very sticky. Once a company or government makes a contract with Palantir, it is likely they stay with them for a long time. Also, their business model has very high margins because it's a software business. Palantir has also an amazing balance sheet. The debt is the difference between the market cap and the enterprise value. The enterprise value is usually higher, but in this case it's lower. This means they have some cash on hand and very little or no debt, which is amazing. Now, I am going to use my Excel spreadsheet, which tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. Because even though I like the fundamentals of the business, you can still overpay for a good business. I am going to do a 7-year analysis and do low, middle, and high assumptions. These are my assumptions, and let me explain them before revealing the prices. In terms of revenue growth, looking at past revenue growth and analyst estimates, I believe this company should grow between 15 and 25% per year for the next 7 years. Then for their margins, they have been making free cash flow, but their net income has been negative. The reason for this difference is probably because they are deducing a lot of their software costs as time goes on. So this does not worry me. For my assumptions, I went with 15, 23, and 30% margins on both free cash flow and net income, because they should be equal in the long run. Their gross margin is very high at 79%, so I think that these margins are achievable. For P and price to free cash flow, the market average is usually around 15. But because this company has growth potential, a great balance sheet, and a great business model, I think it should command higher valuations. This is why I went with 20, 23, and 25. Then for my desired return, because you can get around 9 or 10% investing in an ETF, if you take the risk of investing in an individual stock, your desired annual return should be higher. And because this company is riskier, because it's still relatively new, I went with 12, 14, and 16. And as you can see, according to my Excel spreadsheet, Palantir looks a bit expensive, as the company is worth between $4 and $14. In conclusion, I believe this is a great company with good fundamentals and a great balance sheet, but that is expensive at the moment. I think I am going to start buying this company if it hits $8 a share. But as always, you should do your own research. This is just my opinion. I hope you enjoyed this quick stock analysis, and I'll see you on the next one.